I just had one
Call the regular meeting to order and approval of minutes from October 13th, 2021.
The only correction I saw was we should say capital raise, not capital rise.
Right.
Otherwise, look good.
Okay, any other changes? If not, is there a motion to accept the minutes?
A motion to accept the minutes.
Second,
Second.
as amended. All in favor?
Aye.
Opposed? No, passes unanimous. Are there any public comments? No, if there's no public comments, we're going to move to approval of the pension applications. Is Jerry out there? I have a copy.
I know it's a given on the pension application where it says designation of beneficiary. I know it's a given because I could do the math, but it doesn't say Gabriella gets 30%. I'm sure it's okay.
Well, you know what? I'm glad you mentioned that because I noticed the same thing. But it says designation of beneficiary. And usually this is one of the things it says is as my primary beneficiary to receive any benefits payable upon my death from the city. So they have Gabriella there listed, right? Then to complete it, only if more than one beneficiary is named, they have 30, 30, and 10. But I think that.
Yeah, they should actually have Gabriella in the bottom box there.
That's right.
So we should have this fixed.
And we don't have Jerry here to do that. So I don't know whether, because I don't want to have any, it does seem like a small technicality, but I wouldn't want at some point in the future, if something happened, when I read this, it would seem to me that Gabriella would get all the money.
I think you're right. I think we should send it back. Do we need a motion to table it for now or motion to send it back for correction?
Yeah.
I'll move, we send it back for correction.
Okay, so Charlie's got a motion to send this back for correction. And is there a second to that?
I'll second it.
Joe seconded. Is there any discussion? If not, all in favor?
Aye.
Opposed? No. Be sent back. Okay,
You want
Columbus
to
Circle.
approve the calendar for next year while we're here?
well, that was like on the schedule number 6. We could do that now if you'd like,
Whatever, it can wait. That's fine.
you know. Well,
Let's-
let's let Columbus Circle
Yep.
enlighten us. You're on.
Okay.
Maureen, you want to start?
Sure. I want to be sensitive to your time and everything that you need to get to. Is there a time that you want us to?
30 or 40 minutes, depending
Okay.
on, what you have to say and what questions are asked.
Okay, perfect. Thanks very much, Frank.
Yeah.
We appreciate the time tonight that we have with you, and we look forward to a good discussion. Let me just make a few introductions and opening comments. I'm Maureen Hayes, and I lead our consultant relations effort on behalf of our relationship with Callan, and I work closely with my colleagues at CCI. I'm here tonight with Chris Corbett, who is the lead PM on our SMID strategies and small cap strategies, as well as leads the relationship for your investment portfolio. Mark Shapiro is a co-portfolio manager on the 3 CCI strategies, the SMID, the small cap, and the mid cap. And I'm also joined by Rich Gates, who is our product specialist for our CCI strategies. I thought I wanted to make a few opening comments to set the stage, and then I'll turn it over to Chris for the investment discussion. First of all, we want to thank you and Callan for your support. While we recognize that our investment results are very competitive and we provided strong alpha for your plan, we are also aware that firm developments can have an impact on research and due diligence. And we want to be able to discuss some of those firm developments with you tonight and address any questions that you could have. So Cliff, who was the lead portfolio manager on your account, retired at the end of 2020. And it was a planned retirement. It was on the radar as far back as 2 to 3 years ago, I think even when he last met with this committee. Chris and Mark had worked with Cliff for over 15 years. And they were, we were encouraged, principal, that there was a deep bench at CCI to draw off of and to transition, to do a generational transition from Cliff to the existing investment team. Chris joined in 2006, and he joined as an analyst and then was promoted to co-PM in 2017 and then PM in 2019. And Mark joined in 2004 and was promoted to co-PM in 2020 in recognition of his contribution, but also as we were preparing for the expectation that Cliff would be retiring at the end of the year. With Cliff's formal announcement in 2020, mid-2020, we had preparations in place, and he took on a role as senior advisor to the investment team, away from day-to-day decision-making, leaving that to Chris, Mark, and Micah Iacona, who leads our mid-cap strategy, who's not with us tonight. So also in the beginning of this year, Principal and CCI transitioned all of the operational and back office functions, including trading, over to Principal Global Investors. And this is a model that we have with our other 10 investment boutiques, where we work with them from an operational, distribution, trading point of view, and give them autonomy to run the investment function as they would see fit, as if they were an independent investment boutique. So an example of how we're working together is the lead trader from CCI transitioned over to Principal and joined the Principal Global Equity Trading Desk. He continues to be a dedicated resource to CCI, but he has the broader reach and depth of colleagues and footprint of a global trading desk. So that's an example of how we integrated and provided synergy to the operations for CCI. Principal's made a big investment into CCI with this transition, and we're positioned for growth. And we're looking forward. We see CCI as a key investment partner and a premier offering of growth strategies in the small, mid-cap, and mid space. And that was a gap that we wanted to fill at Principal. So we're looking forward to continuing our support of them and broadening their distribution efforts. So for example, an example of that would be that they have access to an international sales team where previously that wasn't typically in their. So Principal continues to support them as an entity. We are looking for opportunities to grow the strategies and look forward to partnering with them in years to come. So before I turn it over to Chris for the investment review, I know I've given you a lot to absorb and to think about. Let me just see if there are any questions that you would like us to address up front on the firm, on the team, on the transition, and then if so, we will. If not, we'll go directly to Chris.
Does anybody have any questions?
None
No.
here.
I just have one, Maureen. Is there any, in terms of break even for Columbus Circle and Principal and assets under management, is there any key target that the firm has in terms of profitability?
I'll say that, Brett, I've been in plenty of discussions, over the last year, and there really is no break even that's out there. They had a big investment in us and putting us onto their systems, have some, longer term incentives in place for the portfolio management team, that's out there. And they're really committed to growing this business. Obviously we had some client attrition that was expected, as there are with any legacy relationships, but we feel we're kind of getting to the point where our foot is going to be on the gas soon in terms of growing the strategy as we move through all distribution channels available, whether it's through Maureen and her consulting relations team, or other account executives throughout Principal, as well as she mentioned, the international team.
Is the operational and integrated at this point?
Yeah, that took place January 1st, and it's been very, very seamless. that I think there's probably some pluses to it as well. The most of last year, we operated basically our morning call on a conference call system. We've moved to the Microsoft, I guess it's the Office 360 platform and Teams. And, we have video calls every morning now. And even when you're calling any member of the team during the day, it's a video chat, and it certainly adds a more personal touch to it as opposed to talking to somebody on a phone. But it's been very seamless overall. Tracy and Rich, in terms of the marketing angle, are still there. Rich is, picked up the new role of product specialist, but most of the contact there is seamless. And then, as Maureen mentioned before, Dan Dodge, our head trader at CCI, is specifically assigned to trading our account. So there's really been no change for us overall, other than, we switched from the Ed system to Charles River, which maybe took a week to get really proficient in, but it's like, pretty much like using our old system right at this point.
And I'll add to that, Chris. I'll just state the obvious, that the integration with Principal adds a lot of scale and a high level of expertise for back office functionality, and also obviously decreases the cost and helps with the profitability, to Britt's question there. And I think more importantly, it allows the investment team to really just focus on managing a portfolio and delivering returns for the city of Norwalk, as opposed to managing a business. So the model has been great for us, and it's really going to pave the way for a bright future for us as we look forward to better times ahead, despite the lower AUM that we have right now.
So the 2021 returns is the new management team, right?
Yeah, 2020, 2021, but I was also a portfolio manager in 2019, and had full authority during that period, and contributed quite nicely to those return, to that year as well as, Mark and myself and Mike have been around contributing a bulk of the returns over the last, 15 years. So, but specifically to answer your question, 2020 and 2021 are under the new portfolio managers.
And what percent of attrition on the assets under management have you lost, out of curiosity?
Maureen or Rich, do you have that number?
Yeah. Well, it depends what time frame you're talking about, but
Let's say this year, 2021 year to date.
Right. So we're at 1.7 billion and as a firm AUM. And so I think probably at the beginning of the year, we were probably 2.5 to 3. So we lost maybe two relatively large accounts. And then that really had to do with Cliff's retirement.
Yeah.
Yeah.
And it didn't affect any positions, unwinding any positions or anything.
No, not at all.
Okay.
Any other questions? If not, continue on with the presentation, please.
Okay,
Chris,
sure.
I'll turn it over to you.
Sure, no problem. I guess I guess I'll talk a little bit about performance, unless anybody wants a refresher on the overall process, investment process overall. What would be more helpful to you guys? Anyone have an opinion on that, or?
Yeah,
Let's go.
I think we saw your process before. I'm fine. I don't need to hear it again. I'm good with that.
Yeah.
Okay. Well, I guess in talking about this year's returns, which you can see our performance, I think, is on page 2 of the presentation, then an attribution on page 3. But I'll start by taking a little bit of a step back and putting them in context of what's happened since I guess I last met with you guys at the end of 19. So in the context of COVID in the last 2 years, the first half of 2020 was very, very strong period for us and for our style. We typically get paid for the names we hold and our strong results when growth becomes very scarce. And that certainly occurred at the beginning of 2020 as COVID took hold. We held many secular growth focused names like we always do, open-ended stories that can generally cut through any economic environment, no matter how poor it could be. And, at the time we owned some work from home beneficiaries, Everbridge, which had a COVID tracking solution that companies were using for their employees. Ring Central, which is a little bit like Zoom. They have a IP-based phone system that could quickly transition people from the office to home, but has also had some video chat, a new video chat functionality of their own. We own names like Fox Factory and Yeti that benefited from the consumers' move to outdoor activities as they tried to avoid indoor places with COVID running rampant, as well as owning delivery businesses like Papa John's that we had originally owned as a new management-driven turnaround story, but became a very strong beneficiary of COVID as people got sick of eating their own cooking. As we approached, I guess, late summer of 2020, the economy had entered a recession, and we were starting to see the signs of the Fed starting to put its support in back of the economy with rate cuts. And you saw the emergence of COVID vaccines, which sort of signaled an end was coming to this to this pandemic, or at least we thought at the time. I guess in the context of when you think of how Columbus Circle has traditionally performed, we tend to do really well in the later, I guess, in the mid to later stages of an economic cycle. Typically when the Fed has its foot on the gas and the first year of a business cycle where it's sort of propping all assets up, you see a lot of cyclical companies that may not have any real differentiation, like the metal bending industrial companies and such. They get a bid put underneath them because the Fed's cutting rates, and everybody will benefit over the near term as the market's flooded with liquidity and the economy starts coming back. That's been a very difficult time historically for CCI because it's there's not much differentiation among the companies. You don't really get paid for growth. So we took the lessons that we learned, I'll say at the beginning, coming out of the last Great Recession, and even through the quantitative easing periods in 2012 to the 2014 timeframe, and decided the new portfolio management team decided to avoid that. We'd weight the economic essential story element. We break our stock. When we look at any stock, we break it into the 3 to 5 key drivers that we think if you knew in advance, you'd be able to tell how the stock plays out. Essential story elements, and they come in 4 fashions. It's secular, company specific, an industry related, and then a more of a macro one. The macro one's our least favorite because it changes so quickly and it provides little differentiation. But what we did was we decided to weight the macro essential story element and the leading indicators. The Fed rate cuts are obviously the leading indicator of better economic times ahead. And the vaccines were also indicators that would probably succeed as a driver. We weighted that more heavily and leaned into more cyclical growth stories at the time, as opposed to digging our heels in on expensive growth stocks, which ultimately sold off as the market, came ripping and roaring off the bottom in early. I guess it was it came ripping and roaring off the bottom as a whole in early March, but cyclical stocks really started taking hold in August, September when vaccines came to the surface. And I don't want to suggest by any means that we were buying, the average, like I said earlier, the metal bending company. We were buying cyclically based growth stories that are typical of the Columbus Circle investment discipline, that had a lot of company specific differentiation, secular growth stories on the margin, but were, when you talk about cyclical growth stories, they are dependent on the economy. So we bought some names like Shake Shack, whose business got bombed out by the closing of New York City, Cheesecake Factory, another restaurant chain, which reinvented itself by transitioning very rapidly to at-home delivery. names like in the auto space, like Visteon, that had a very strong secular growth story. And as auto production came back, they'd benefit not only from the production growth and the content growth. And we tilted our portfolio more on the margin towards those names. And it allowed us to have, I think, a very successful second half to 2020 when at a time when CCI would typically give back performance. And I think we, really successfully avoided that in what would have been a typically more difficult time for our philosophy. That served us well up until I guess I'd say April and May of this year, when the COVID Delta variant reared its head. People were thinking about peaking economic growth, on a GDP basis in around the June summer time frame, as well as the Fed hesitated a little bit in the face of rampant inflation, and it made some people think there was going to be a policy misstep. So the market started rotating back towards secular growth at that time. We had identified that early on. I remember we had a meeting, I think it was sometime in April, where we cautioned our analysts, it looks like we're going to start heading back more towards a secularly driven environment here as some of the stuff rears its head. So we think that the cyclical trade off the bottom is over, and it's rotating back towards where the type of investments you think of as you get to Columbus Circle, the secularly driven cloud-based tech stocks. So we began the transition to move for much of 2020. We had been about, I'd say, 900 basis points overweight consumer discretionary, and we had gotten underweight, I think 500 basis points plus technology. And if you looked at our weightings, for maybe the 2 years prior to 2020, we'd probably been as much as 1,000 basis points overweight tech, and 500 to 1,000 basis points overweight healthcare at the time. So it was uncomfortable for us to be underweight that. And we moved when we felt the market was moving back to more of a growth mode. We moved the portfolios more back in line with where the benchmarks are. We got more to an equal weighting on tech and to try to bring consumer down. Since that time, tech's a modest overweight at this point, and consumers a modest underweight here as inflation takes a little bit of a bite out of the consumer's pocketbook. I'd say we had a little bit of a blip as we repositioned the portfolio in the second quarter, but it's really served the purpose of what we thought we wanted to do. The third quarter results, we started seeing, I guess as we got into August and September, we started seeing our performance turn on a relative basis from, it's been a little bit more choppy period in the month of June, when laggards year to date had led the leaders, up until the month of June. So you saw us, we were down 1.3% in the September quarter, but we, versus the benchmark, that was about 220 some basis points of positive alpha, and it brought us more positive year to date. Since that time, we're through the bulk of our third quarter earnings results at this point. And as we've gotten into the fourth quarter through the fourth quarter reporting, we've seen the market more willing to pay for a lot of the names. As I said earlier, we moved to equal weight because, we thought that the tailwinds are starting to shift a little bit more towards growth, that growth's going to become a little bit more scarce as economic activity had already peaked, at least on a year-over-year growth basis. That's not to say the economy will stop growing. We positioned ourselves, more equal weight to tech stocks, and we also maintain a healthy weight of economically driven growth stories that would benefit as employment continued to grow, probably a little bit more of a different mix going forward. Just a kind of an example there, I'll say that within like consumer, for instance, rather than owning the restaurants like we did earlier in the year, we've gravitated more towards stories like Academy Sports. I'm sure some of you are probably familiar with Dick's Sporting Goods up here in the Northeast. It's similar to that. It's been more of a Southern chain. They've partnered with Nike and have been able to show strong same-store sales comps as they've benefited from the demand for leisure, but they also have better access to Nike's product, and there's a certain level of store growth that's there. So it's and they have quite a bit of room to expand their footprint as they eventually look to go national. But right now they're just kind of expanding out from their, say, Texas Southeast base. So, we've owned some names like that. We added to material. We're overweight materials names as well. That's something that's happened, I think, as we exited the summer. When you think of materials, you kind of think of cyclicals, but what we've owned there has been a combination of lithium plays like Albemarle and Livent. They're the low cost producers of lithium carbonate and lithium hydroxide, which are benefiting from the explosion of electric vehicles that's just beginning and probably has quite a long tail to it over time. What else do I want to mention there? I'll say fourth quarter to date has been good. I guess after today, the market was obviously down a decent amount today, but after today, we're probably up in the vicinity of 9.5% for the quarter. That's probably somewhere in the vicinity of 250 basis points of positive alpha versus the Russell 2500 growth benchmark. Year to date, we're 16-17%, somewhere in that vicinity, up maybe about 400 basis points on a relative basis. So we're pretty pleased with where we are. I'd say we think it'll be choppy still. You have these big fiscal packages coming through Congress, which will no doubt the spending from them probably reignite some of the economically driven names at points in time here. But we think with inflation, growth is going to become more scarce here as we go forward. And I think that's going to be a tailwind overall to our discipline, with some ebbs and flows over the next year. So my message overall to you would be, we think we've made it through most of the difficult portion of the cycle where Columbus Circle has traditionally tripped up a bit. And, we're coming out the other side, and, you have some tailwinds at our back. Growth's likely to become more scarce here. And I think you'll see the market reward our discipline for our strong stock picking and secularly growth type ideas. So I'll pause there and see if anybody has any questions. I can certainly talk about the portfolio more or any other questions you might have.
Yeah, I have I guess it's more of a process question and a organizational structure question. But if you look at some of the areas where some of the segments you're most heavily invested in, like healthcare and technology, talk a little bit, if you would, about your staff expertise and in those areas. I think in healthcare, you focused on the pharma side of it, the delivery side, and how do you feel about your expertise versus others that might specialize in that solely?
Yeah, okay. So I would say that, being growth investors, we've had to, over the years, be very invested in those sectors because that's where the most fruitful ideas usually come and the returns that we generate usually come from. I think the attribution on page 3 this year is somewhat unusual, given that, healthcare and information technology have been, areas of detraction. I'd say that's changing around here too as we go in the fourth quarter. I don't know if it's fully positive yet, but information technology has contributed much more positively since I'll say mid-year. Mark Shapiro, the co-portfolio manager on this call, he still has coverage he's followed the healthcare stocks for us that have contributed handsomely to our returns over the last, I guess Mark's followed that about 3-4 years. The diabetes names, that was a big theme for us over the last 2-3 years, where we've made a lot of money. Other medical technology device names like Inspire Medical, that had a sleep apnea device. We've owned a lot of names like that. There's some in the portfolio now as well. So Mark's knowledge there is second to none. So I would say that, we feel very good about our expertise there. Plus I've actually, I know that sector quite well as well. Historically and now for that matter, we've never really been big fans of the biotechs, because when you step back from our investment process, We identify the key essential story elements / leading indicators that are going to drive any given stock. We try to boil it down to its most simplistic form. That's why I say, like, we try to identify probably 3 things that if you get them right, if you identify what it is, you'll get the stock right over time. And they're usually leading indicators. And we like them to be trackable. So if you're for instance, like an auto company, one of the ESEs, like Visteon, for instance, which is no longer in the portfolio, they've typically grown their content 10% above the 10% above the auto market. So if you're tracking what auto sales are doing, which is the leading indicator of production, you get that monthly. You can kind of have a good idea of what Visteon is going to report if you're paying attention to what models are selling well, what aren't, as you get towards the end of the quarter. To pull that back to healthcare, biotechs are, especially the early stage stuff, is generally a science experiment. So we've typically never been fans of that because, the drug trial completes itself and everybody's sitting there waiting. It's like the Oscars, and the envelope, please, and you're either up 20% or down 20%. So when we're looking at names in that space, we're looking for companies where we have seen some validation of their drug candidates already, strong validation, whether it be through them, through other comparable companies where there's a class of drug that's being validated overall. And we like to see them have more than one leg to stand on so that you're not left holding the bag if something goes wrong there. So I'd say we're not really fans of that space overall. We have, we're comfortable picking stocks there, but we'd rather not. Over the last year, that hasn't been much of an issue because the XBI has broken down and hasn't really acted all that well. And today it rolled over. A lot of the biotech stocks were down 5-6%, at least the ones on my screen.
Yeah.
So
you're not trying to be a venture capital firm.
yeah, exactly.
Right.
Chris,
Okay. Got it.
That being said, Chris, the largest position in our portfolio right now is a biotech company, correct?
Well, it's Horizon. It's been one that's has launched where you can track the sales of their drugs. So it's a little different than like an early stage biotech company where you're dependent on the trials. Their lead drug is Mark. Do you want to talk about that? You follow it. It's Tepezza, which is for thyroid eye disease. But go ahead, Mark.
Yeah. So Horizon, they have two key products today that are driving the bulk of the sales that are in commercialization. One for dry eye and one for gout. So we can track the scripts and we can pretty easily identify, reality versus expectations there. Both of those drugs, sorry.
Is that an increase in value, the reason why it's 4%, or are you buying up to 4% of the portfolio?
No, that has appreciated to 4%.
Okay.
And also part of the story, which makes it just as attractive as the commercial drugs today, is they recently had an R&D pipeline day where they went through a number of drugs that are in their pipeline that, this is a pretty credible management team. And they indicated that kind of in the back half of this decade, which I know is not the next quarter or 2022, but in the back half of the decade, they think there's a number of approvals that will come to market and actually accelerate their sales growth. So it's a name that we feel comfortable owning in size, because of the current commercialization of two pretty powerful drugs, along with a very credible management team that has been pretty vocal on a very robust drug pipeline that we would expect to hear kind of incremental positive data out over the next, call it, probably 9 to 12 to 24 months.
And I'd say the key thing there too is that we are able to track it and get a idea of what the sales are on a monthly basis through some of the script data that comes out there. So we have recently reduced it because the market didn't react as positively to their recent earnings report. It was actually better than expected, but it was a little tepid of a reaction. The stock didn't go up. I don't think there's anything to be concerned about there, but we'll let the market digest the move, and I think there'll probably be better days ahead. But aren't likely to exit the whole position, but I think it was prudent to reduce it at the time.
It had appreciated into that R&D day and thereafter. And then so we took a little bit off the table.
Yeah.
What is your maximum position in any one stock?
It's 5%. You know, generally we start out buying 50 basis points of a company. And as we feel that the essential story elements, you know, the key indicators have been validated, we will add. Generally, I'd say we don't really add above 3%. You know, if it gets to 3%, we've added a number of times. It's had a lot of validation. It's appreciated. We've made money on it. It usually goes from 3 to 5% on you know, appreciation alone. And you know, if it goes over 5%, we cut it back.
Thank you.
So, and just to close the loop on the question around on healthcare and technology, our expertise in technology is very good too. We, you know, I personally have followed many aspects of the technology industry since 1999. You know, I no longer have primary coverage on any of our stocks, but I certainly have opinions related to basically anything that gets touched in there. But you know, we have a semiconductor analyst who's been with us since I guess started a little bit after me, so probably 2008 or so. And you know, we recently hired well, recently, it's not that recent anymore. I guess he's been with us over a year now to follow us. He had followed software at a previous firm he's at, and he's very, very good. Justin Keating, who's a young one of our analysts who's been working in the software industry, following the software industry in a style similar to ours for the last, I think it was 6 years or so. So we feel very good about our capabilities in both those areas. And I think our process overall allows us to, you know, digest the information quickly, which is important in the technology world because you get big moves and you want to get in there before the world knows, because then you're taking on more risk if you're too late to the party and wrong.
What are some of your newer additions to the portfolio?
The newer additions, let's see here. Let me look at my screen real quick, because I always tend to forget what we've bought more recently. I get thinking that, you know, I guess some names, like I'll talk a little bit about how we've bought, you know, when we brought the SaaS weighting, the software as a service weighting up over the summer. Zoom Info is one name that we've bought. We bought it pretty well too. It's been a good stock so far, but we think there's more to go. Basically, what that company is, it's a CRM. I'll call it an add-on to CRM, but they have the best overall data of where people work. So if you're a sales guy looking for you know, contact information for various employees, it's the most up to date. You know, it can give you a list of like who's head of sales, who's in charge of the West region, the East region, et cetera. They've done a very good job of targeting the enterprise. They've have good relationships, and because of their sales model, they have very, very high margins. So it's been growing, I believe, close to 40% this year with margin, I think cash flow margins that are near 40-50%. So not only is it a good top line growth story, but it's delivering on the bottom line as well. And it's been one that's really sort of opened people's eyes, you know, over the last year. What else have we? Let me turn the page.
Chris, we bought back Plug Power, which has been that was a very successful stock for us last year. They're in call it the hydrogen fuel cell business. We had initially purchased the stock on evidence that their forklift or material handling fuel cell technology was being adopted at a faster than expected pace. You know, some of their marquee clients at the time or customers were the likes of Walmart or Amazon for their warehouse facilities. You know, we wrote it up pretty successfully last year, took profits in it just because it had gotten way ahead of itself, and then bought it back in the last few weeks. Just that, you know, the fundamentals remain very strong. They're expanding beyond material handling and forklifts and into other applications. and not only in the fuel cell business, but on the electrolyzer side of which is basically the electrolyzers produce the hydrogen. So they're basically vertically integrating the business, and therefore the TAM is blowing out, or the total addressable market is expanding significantly. They've raised 2 weeks ago, they raised their short-term and long-term revenue guidance by a pretty material amount, and we still think there's a lot of upside to go in terms of estimate revisions higher. There's competitors in the marketplace, but they definitely are the leader today. So that's one that we had owned in the past, but we recently purchased again.
So you're buying it on revenues, not earnings.
Yes.
Yeah.
They today they actually run at, I think the last quarter was actually a negative gross margin. So definitely losing money today. But that's partially a scale issue, and partially given COVID and supply chain impacts and all that's hurt their profitability as well. But as they vertically integrate and they become not only the consumer of hydrogen in their fuel cells or the fuel cell product, but the producer of the hydrogen with their electrolyzers, we think that you'll see a nice kind of hockey stick. Not probably until probably middle of 22, late 22, you'll see an inflection in the margin profile of the business, which will lead to a pretty powerful earnings story, out a couple of years. We're not, obviously, to your point, we're not buying it on, the earnings this quarter or next quarter. We're buying it on the bookings as well as the revenue results today.
Are there
Go
many
ahead.
companies in the portfolio where you would consider yourselves to be one of the top 5 shareholders?
No, we wouldn't. We don't take positions of that size. We're over, I think officially over 5. We don't file as a 5% shareholder, and to get to that level, we wouldn't be able to get there anyhow. So at this point in time, so I'd say Mark with the Plug Power, Mark was sort of jogged my memory and looking at the theme page here, some of the newer themes. I'd say that alternative energy overall, I mentioned before Albemarle and Livent contributing in the third quarter. Those are relatively new buys in the end of the summer. Those are, as I mentioned before, plays on lithium. And I think they'll benefit more should it's likely some form of the next, I guess, Build Back Better bill gets through. We'll see what's in it at the time, but electric vehicles are heavily incentivized in there, and I think that's likely to be a benefit to those two names, which we still own. And also on the far right of that theme page, infrastructure related names, Eagle Materials, Summit Materials, they both have aggregates businesses, so they're benefiting from infrastructure spending, roadway spending as they make aggregates. Eagle also has a wallboard business that's tied to new home building, and that industry has gotten more disciplined over more recent times, and you've seen a lot of pricing power, and the industry is basically sold out. So they're likely to see as some of these supply chain headwinds normalize over the next, call it 6 to 9 months, you'll see them start to hopefully print some money from that division as well.
Have you gone into the SPAC space at all?
No, that's one thing I've been very leery of SPACs. Back in the day, I can remember for the last at least 10 years talking to Cliff about them at various points in time, and it's always been my perception of them too, is that they don't receive the same level of due diligence that an IPO receives. So you're kind of, and even looking at the ones that have come public, forget about the fact for a minute that a lot of them are trading under the SPAC price at this point, but they're very, a number of them anyhow, I don't want to say all of them, but are very promotional because they need to be to get out there. And then it's not really clear who's done the diligence on a customer basis. The investment banks haven't had to sign off on it. So I think you're taking on much more risk. So we have I don't believe we've had any in the portfolio. I could be wrong that we've had one, but I don't believe so. Sure if anybody else has any other questions about the portfolio, if there's anything else you'd like me to chat about here.
Any other questions?
Keep up the good work. We're happy.
What
We'll
about,
try.
Good to hear. We appreciate the confidence.
one
Yeah,
other
yeah.
question? What do you think of the market in 2022? Next year?
What do I think the market? I don't know. What a question. Anytime I try to prognosticate on the market, it ends up not always being right. I think it's going to be a little bit of a tough go here. I mean, we've had a big run here at the end of the year. You know, there's a lot of, you know, back and forth. There's been a lot of rotations underneath the surface. I think the market's going to have to work through some of the fiscal spending, you know, weigh that against inflation, whether the Fed actually has to act sooner than expected, which, you know, that's certainly not off the table. Although as interest rates get raised, it does, you know, present interesting what that would do to all the debt that needs to be refinanced and issued on an ongoing basis. So what that would do to the economy overall and all the companies that are out there overall. I mean, everybody's heard the acronym TINA, that there is no other alternative, right? It's equities. So I think as long as, you know, the Fed doesn't overshoot and the winds at the back and inflation can run under control, I think the market can grind, but there's a lot of risks. I think it's going to be a little bit choppy, but I think that because growth will be becoming more scarce, I think we'll be able to do well.
Any other questions?
No,
Okay, I want to thank you all for
Thank you.
presenting.
Thank you.
Thank you.
Thank you.
Well,
We appreciate it.
Yeah, thank you very much. We really appreciate your business. Well, thank you.
thank you.
Yes.
All right.
And happy to come back anytime to address either investment or firm-related issues. And a lot of us are just right down the street from Norwalk. So once we can be back in person.
Excellent. Yep.
Okay.
Thank you very much.
Thanks. Enjoy the rest of the year. Bye-bye. Thanks.
Thank
Britt.
you.
Bye.
Thank you.
Okay.
Britt, performance? Any discussion on this?
Yeah, I was
Anybody
just
wanna-
gonna
any
add-
comments?
Got a few comments, if you recall. I mean, we've had them in a few times recently, and Cliff Fox was really the key person there for a long time. And I think from our perspective, we had confidence in Chris, and he's done very well since Cliff has left. I think at this point, the real kind of question mark is the firm and strategy AUM, which is why I asked the question about break even. But given that Principal is really their owner and partner now, they do have the backstop of a very large firm, which gives us confidence in them continuing to do what they do and continue to successfully manage small and mid cap stocks. So leave it there. Happy to discuss further.
One thing is to go from, say, 2.5 to 3 to 1.7, that's a pretty big drawdown.
Yeah, I mean, full disclosure, I think they have, I can pull it up. In this mid strategy that Norwalk is invested in, there are 6 total clients and Norwalk is the 3rd largest.
Hmm.
So that really is what prompted them to come back in this evening.
Mhm. Okay, yeah, they're
What
doing
about
okay. We'll give them some more time here.
Yeah,
Thank you.
one other thing is, you know, they give it with gross. Do you know what the fee is now?
Yeah, give me 1 sec. It is 75 basis points.
Thank you. Anything else? Anyone?
No.
Any other comments, Britt? Would you like to go on to performance review then?
Sure, happy to. Give me 1 sec. I will, I'll share my screen here.
You're doing the executive summary one, Britt?
Yep, exactly. Can everyone see page 3 here, the executive summary?
Yeah, oh, there we go.
Yeah.
Is that a yes? Great. So I'll just spend a couple minutes on kind of where markets ended as of 9:30. Here in the table, we show the quarterly returns as well as longer periods. If you recall, during the quarter, we saw a number of headwinds from issues with the debt ceiling and infrastructure bill trying to get passed. We've certainly seen supply chain issues and some real estate issues in China. And then the tapering of the bond purchases with the Fed certainly caused some kind of muted, really mixed bag full performance for the quarter. And that compiled with inflation and uncertainty regarding inflation really led to some differentiated returns here. And you'll see, most broad market equities and fixed income were flat. The US dollar performed well, so international equities for US investors were hurt by a stronger US dollar. You can see emerging markets equities down about 8% for the quarter, really driven by some of the issues in China and Brazil. So overall, pretty muted quarter for risk assets. I mean, the 1 year, 3 year, 5 year numbers, extremely strong for equity markets. You can see the S&P 500 over the last 10 years up over 16.6%. Developed international markets up over 8.8%, et cetera. So long-term returns continue to be good. I think Chris mentioned, uncertainty going forward. And I think that is really kind of our thought as well from Callan perspective is, we might see some headwinds here going forward, and continuing to stick to your strategic asset allocation is really what we're preaching for our clients. To give you a little background on since September, quarter to date, the S&P 500 is up almost 9% through yesterday. Growth continues to outperform value in large cap stocks, as well as small cap stocks. And then really muted returns in fixed income continue, but the ag is up about 70 basis points through yesterday for the fourth quarter.
When you say headwinds, does that really translate into you see a correction coming?
Well, I don't know. I think there are real inflation concerns, and whether it's transitory or not remains to be seen, I think, from our perspective. And I think there are serious supply chain issues. I think we're all seeing it. If you want to go buy a toaster or, a new stove or a new fridge, you're not going to get it. And how that plays out with the tapering of the Fed's bond purchases, I think will cause some volatility. Whether that is all bad or mixed remains to be seen. But I think from our standpoint, we've had a pretty unbelievable growth here in the last 2 years, and we are, if it was my opinion, I'd be I'm personally cautious.
Yeah,
Would be my view.
yeah.
Hey, Brett, with the muted returns in fixed income and our stance or the stance of possible inflation, what's the possibility of a TIPS allocation replacing a basic bond allocation for our fixed income? Would we have more upside potential?
You might, but you may have already missed it, given where we've seen the last couple quarters and inflation go. I think we certainly wouldn't recommend replacing your bond allocation. Typically, we see TIPS as a part of your fixed income allocation. I would say that within PIMCO, you do have TIPS exposure there, and inflation protecting securities within that portfolio.
With the all asset portfolio.
Correct. So I would say
What's
I'm
the
sorry, go ahead.
downside? What's the downside to a tip portfolio? Is it the same downside as owning a bond? Or is there more downside?
I don't know if there's more downside. I would say if anything, there's probably a little bit less downside, but I'd have to follow up with you to properly evaluate that.
I'm just curious, because if we're wrong and inflation's not transition, you know, if it does take root, would we not get a bigger bang for our buck in a tip portfolio as opposed to a flat out bond portfolio?
Yeah.
If there's no more downside.
That's
What are
fair.
risks?
I mean, I think over the last quarter to date and over the last quarter, tips have outperformed with the inflation we've seen. That being said, longer term,
Yeah,
you know, historically, I mean, you think about how little inflation there's been in the markets for the last 20 years.
okay.
The allocation has returned next to nothing historically. So recently they performed better, but you know, certainly a different animal than just owning the aggregate in your core plus manager TCW. But it's something we could explore if the board is interested.
No, I'm just curious because we're getting nothing on our bond portfolio. We'll get nothing on tips if there's no downside.
Well,
What do
I
we-
think that is the reason it's in the portfolio is not necessarily to generate returns, right? You have your core and core plus bond managers when equity markets go down 5, 10, 15%, they're going to be your ballast.
And wouldn't tips do the same thing for us?
They would not operate the same way. They could, I mean, we could do some analysis to show, you know, downside tips versus the ag and see how they play out. Honestly, I have never looked at the tips index that closely. So I would have to.
We've never had inflation until recently. And, you know,
Right.
if by chance it's here to stay, like the 80s,
Yeah, no, it's certainly something we'd be happy to explore with the board and bring back some more information.
Okay.
You want to continue on there?
Sure, happy to. So in terms of the asset allocation as of September 30th, not much has changed here from past quarters. You can see slight underweight to domestic equity and a slight underweight to domestic fixed income. And really the big overweights here were PIMCO, which, you know, to Joe's point is really the inflation protection allocation within the Norwalk portfolio. So it's overweight, about 7.5% versus 6% target, and a little bit of an overweight to cash. Given that I think the city's, not the city's contribution, but we raised cash for benefit payments. And then I would just highlight private equity has ticked up with some capital calls to 4%, but long-term, we expect that to go down.
I think we should probably list the cash position as like 2% now, because I believe that we have talked about, you know, because of the need for funding, you know, that we're going to be almost always at 2%, I would think.
Sure. And we would, if you wanted to increase the cash target to probably reduce fixed income by 1%.
I would think that's reasonable, yeah.
Sure.
Does
we can-
anybody,
no, that makes sense.
Yeah, I'm fine with that.
Yeah, I agree.
Okay, we can bring
hey,
back.
wait a
the
minute, did
idea.
Rich Baskin just agree to lower the bonds by 1%?
He still wants Silchester money to go at Silchester.
No, that's you know, we're taking profits, right?
Yeah. I stand corrected.
We will we'll bring back an updated IPS next meeting with the change to the cash position and reducing fixed income. Here we show the asset distribution. You can see about 538.7 million at the end of September. You can see there were some liquidations of PIMCO and some contributions that we saw during the quarter from the city's contribution. So you can see shoring up fixed income portfolio and adding a little bit to BlackRock during the quarter. So everything here is within range except cash, which is really just 0.01% over. No concerns, and we'll bring back the updated asset allocation in the IPS for the next meeting. In terms of performance, within domestic equity managers, LSV had a strong quarter, even though on an absolute basis, they were down about 1.1%. They outperformed their benchmark by about 1.8. And for the last year, they're up over 2%. So, you know, they've had their struggles. If you recall, their deep value approach has really been out of favor for quite some time, as you can see over the 3 and 5 year periods. There is a performance fee there. So, you know, when they underperformed, they were not getting paid. But it's good to see them bounce back as, you know, they've stuck to their discipline and performed well over the last year. Columbus Circle, another strong quarter. Again, not on an absolute basis, but relative to the Russell 2500 growth, strong performance and really strong performance across the board from them. Within international equity, Silchester performed well, and they continued to be a very good manager for Norwalk. Artisan, we had in recently, pretty muted returns, and you know, if you recall, their quality and valuation kind of GARPy approach, growth at a reasonable price, has really been out of favor. We did have a call with them last week with our research team. We continue to have confidence in them and really believe that they're sticking to their process, and it's really being driven by, you know, the junk growth rally that we've seen kind of across the world for the last few years with COVID. BlackRock underperformed. Most of that is due to some of their Asian holdings, specifically China and South Korea, but continue to have confidence in that strategy and team. Your hedge fund managers, global equity long short, pretty muted returns for the quarter. Strong returns on an absolute basis for the trailing year, up about 16% and 14% for both of them. And just highlight strong returns from private equity over the last year. You can see up almost 38% there.
These are fiscal years, right, Britt, not calendar year for us on this chart.
Oh, I'm sorry, I'm way ahead. I apologize. Here we go. So here we can see just the last year. We're just showing the quarter in 1 year because there's only been 1 quarter in this fiscal year. But you can see that private equity has done very well. And then finally, you can see your fixed income managers have eked out returns during the quarter and year, and both continue to outperform the aggregate index. UBS had a strong quarter, and while they've underperformed for the year, you know, their goal is to really provide positive performance in any market environment. You can see over 3, 5, and 7 years, they've done a good job. And lastly, PIMCO, you know, really strong year. I think for the quarter, most of their underperformance was driven by some of their emerging market equity exposure. If you recall, that was the worst performing sector in the equity markets, and there is some exposure to equities within that real assets portfolio, which contributed to underperformance.
How has the UBS performed in, you know, negative equity markets that are down 10% or more?
I would have to look it up specifically. They have done a good job. I think they've been in the portfolio for quite a long time. Let me see if I can pull up.
I mean, that might be the alternative to, you know, for fixed income, to put a little more juice there. If in fact they're successful at, you know, returning positive numbers almost all the time.
Yeah, so so the way I'm going to look at this is up market and down market capture. So, their benchmark is the hedge fund to fund conservative index. When that index does well, they participate 91% of the time. When that index goes down, they go down less than 40% of the time. So what we like to see in any manager versus their benchmark is an upmarket capture that's high, so close to 100 or more, and their down market capture, especially in a manager like this, to be very low. So if you had 100% upmarket capture and 100% down market capture, that means you're just following the index wherever it goes. So essentially having a 40% down market capture means that, if the index goes down 1%, they might go down, if it goes down 1% 10 times, they might go down 4 of those times. So historically, they've done well.
So if equities correct 10%, you'd expect bonds to be relatively flat and UBS to be down a few percent.
Maybe. Yeah, I think their beta is very low to equities and fixed income. So the idea is uncorrelated beta, where you're getting exposures that aren't necessarily going to go up and down with the equity market. So the beta might be 0.2, 0.3.
Mm-hmm. What's our allocation there again? Couple pages back.
And UBS?
Yeah.
It's 4% target. You're about 4.7% currently.
All right.
Remember, Nick, the cash position here is $10 million, but that's end of September. So we're going to need another about $10 million at our meeting in
January.
$8 to $10 million in our December meeting.
Yep. And Tom mentioned that it was agreed to review raising cash on a quarterly basis going forward. So December, March, June, and September going forward. So we'll be prepared with some analysis to raise cash at the next meeting.
Excellent. Thank you.
That's all I had on performance. The quarter was the first drawback we've seen in a while, but you can see long-term performance for both the benchmark and the discount rate have been exceptional.
Perfect.
Excellent. Is Chitsame, if you're there, is that what kind of money you think you might need? Would that be about it? 10 million in December?
Yes, that will get us through for the next quarter. Right now, we have about 8 million something in cash, and that's going to get us through November and December. So that would be good to have the 10 million for the first quarter of the next calendar year.
You know what, just as a question on the cash, do they pay any interest at all on the cash position we have?
They
And
do.
if not, they do? Okay. Any other questions? If not, we're going to go on to the scheduled meeting.
Do it.
Okay. I did look this over and I went on to a calendar of holidays for next year, including religious holidays. I do believe that we are clear of any religious or other holidays. I don't know if anybody has any objections to any of these dates.
No.
If not, is there a motion to accept the schedule for 2022.
So moved.
Is there a second?
I'll second that.
Is there any discussion? If not, all in favor?
All right.
Aye.
Opposed? No. No one is in opposition. Any other discussion on anything? Jim?
Do we expect to be remote here for another couple, 3 months? What's any idea, Chitsame, what's going on, or Henry, what's going on in the city hall over there?
I'll tell you that we work diligently with the IT department to wire the council chambers so that we could have a mixed meeting in person and on Zoom. Technically, it's non-trivial because Zoom alone is easy, in person alone is easy, and everybody has to have a notepad and feedback and all sorts of issues. So we wired that room. We were looking at another room, the one that we normally use on the 3rd floor. And I don't know whether we've made a lot of progress on wiring that room for mixed. I know masks are okay or not necessary in the city, but they're required in City Hall. So we are still in I'll use the Columbus phrase of choppy. It'll be choppy for the next couple of months. We'll see how we go. Everybody likes the Zoom for the flexibility, but to also be able to be in person is also a tremendous advantage. And I will see if the chambers are not scheduled during our meetings, we could try to arrange to use that and then have a mixed meeting. So I will follow up with Joyce Liu, our head of IT, and see if we can't accommodate if there's a desire to have a mixed meeting.
Yeah, I'm personally relatively indifferent. I was just asking, but at some point we'll want to get back together.
I think, I'm sorry, I think it's coming down from the governor to the mayor of what we're doing and opening up. We're watching the COVID results. I think it's ticked up a slight bit recently, but it's a good trend so far. But we are erring, after almost 2 years, on the side of caution.
Yeah, that's fine. Yeah, and Europe's getting another uptick now, so we'll see what
I
happens.
mean, the biggest thing is
from Norwalk to Manhattan.
the biggest thing is that Joe is complaining, and he says if we have another year of these kind of meetings, he wants some delivery to his home.
I'm losing weight. I'm losing weight. I'm disappearing.
I know. I miss
That-
those bags of
that-
chips myself.
That alone is a reason to have a meeting in person to see that.
But I can't have this.
There you go.
Verify.
It's non-alcoholic though, so
There you
everybody
go.
calm down, non-alcohol. I wouldn't drink during the meeting.
Brett, what about, is Callan, can you come to a meeting? Because I know that it was till November before, I believe.
Yeah, we're remote until January at this point. So I think the plan is to go back part-time in January and can certainly try to make an in-person meeting happen then.
So you would, if we could get Henry to get us into the room in January, you could be able to be there.
Barring any unforeseen circumstances, which we
This
all
whole
know
thing.
is all
You're newly
unforeseen.
married, unforeseen circumstances can always occur.
Yeah, I'm gonna have to put that caveat on there, but assuming things continue in the direction that we're going in, I don't see any issues there.
Past attendance is not
Choppy,
indicative of
choppy.
future attendance. I'm sorry.
Any other questions or discussion?
Henry, you were muted there. You couldn't, we didn't hear what you said.
Oh, I'm sorry. I was trying to make an investment joke of past attendance is no prediction of future attendance.
Okay.
Very good. I think that's a good spot to leave on. So I want to thank everybody and unless
Motion
there's-
to adjourn.
is there a second to that motion? All in
Second.
favor?
Aye.
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 Wonderful.
Thanks,
Opposed?
everyone.
Take care, everyone.
Happy
Good night, everybody.
Thanksgiving,
Have a
everyone.
good Thanksgiving.
Yeah, happy
Thanksgiving.
Thanksgiving.
Thanksgiving. Thank
See you
you.
next month.
Thank you.
Bye.